Something happened in the US bond market recently that most people completely missed, and the ones who didn't miss it are quietly terrified. Not the kind of terrified that makes headlines. The kind of terrified that makes serious, experienced, battle-hardened investors pick up the phone at midnight and call their risk managers. The kind of terrified that doesn't show up on CNBC, because if it did, they'd have to explain concepts that most of their audience hasn't thought about since a finance class they half slept through in college. But you're here, and that tells me something about you. You want to understand what's actually happening, not just what the headlines say is happening. So let's do this properly. Let's go deep into the US bond market, understand exactly what signal just flashed code red, why Wall Street's sharpest minds are paying very close attention, and what it means for your money, your portfolio, and frankly, the entire direction of the global economy in the months and years ahead. Buckle in, because this is one of those moments that people will look back on and say, that was the warning. That was the moment when everything started to shift. And the question is whether you were paying attention. Let's start with the basics, because I think the bond market is one of those things that even financially educated people sometimes have a shaky intuition about, and I want to make sure we're all working from solid ground before we get into the complex stuff. A bond is essentially a loan. When the US government needs money, and it needs a lot of money, more than ever before in its history, it borrows it by issuing treasury bonds. Investors buy those bonds, lend the government the money, and in return the government promises to pay them interest, called the coupon, and return the principal at a specified future date, called the maturity. Simple enough. The interest rate on those bonds, the yield, is not set arbitrarily. It's determined by the market. Investors collectively decide what interest rate they require to lend money to the US government, and that collective decision shows up as the yield. When demand for bonds is high, when lots of investors want to lend money to the US government, yields fall because the government doesn't need to offer as high a rate to attract buyers. When demand is weak, when investors are skeptical, nervous, or have better alternatives, yields rise because the government has to offer more to attract the lending it needs. This relationship between bond prices and yields is inverse. When prices go up, yields go down, and vice versa. Keep that in mind because it's fundamental to everything we're going to discuss. Now here's where it gets really important. The yield on US Treasury bonds, particularly the 10-year Treasury, is not just a number that matters to bond investors. It is arguably the single most important price in the entire global financial system. Think about what the 10-year Treasury yield actually does. It serves as the baseline risk-free rate against which virtually every other asset in the world is priced. Corporate bonds are priced at a spread above treasuries. Mortgage rates are linked to Treasury yields. Stock valuations are derived in part from discounting future earnings at rates that reference Treasury yields. Emerging market debt is priced relative to treasuries. The cost of financing for businesses, for homeowners, for governments around the world, all of it traces back, in one way or another, to what's happening in the US Treasury market. This is why, when something goes wrong in that market, when a signal that financial professionals recognize as alarming starts flashing, it doesn't stay contained to the bond market, it ripples through everything. And right now, that signal is flashing in a way that is drawing very serious attention from very serious people. So what exactly is the code red signal? Let me walk you through it carefully, because there are actually several interconnected alarm signals that are all lighting up simultaneously, and the convergence of all of them at once is what's making experienced market participants genuinely concerned. The first signal is the behavior of long-term Treasury yields. The 10-year and 30-year Treasury yields have been rising, not in the way they normally rise when the economy is doing well and the Fed is tightening, but in a way that suggests something more troubling, that investors are demanding a higher premium to hold US government debt even as the economic outlook is uncertain. This is not the typical pattern. In a normal economic slowdown or uncertainty, investors rush into treasuries as a safe haven, pushing prices up and yields down. That's what's supposed to happen. It has happened in every major crisis for decades. But recently, we've been seeing periods where that traditional safe haven dynamic breaks down, where yields rise even as stocks fall and economic uncertainty increases. This is a deeply unusual and concerning pattern, and it has a name in the financial world. It's called a bear steepener on the long end of the yield curve. And when it happens without a clear positive economic catalyst, it typically signals that investors are losing confidence in the creditworthiness or monetary stability of the borrower, in this case, the United States government itself. The second signal is what's happening with foreign demand for US Treasuries, and this is a story that has been developing quietly for several years, but is now reaching a level of visibility that's hard to ignore. For decades, the US Treasury market operated on a kind of implicit arrangement with the rest of the world. The US dollar was the world's reserve currency. US Treasuries were the world's reserve asset, the thing that foreign central banks, sovereign wealth funds, and institutional investors parked their dollars in. This demand from foreign buyers was massive and consistent, and it effectively subsidized the US government's borrowing costs. China, at its peak, held over $3 trillion in US treasuries. Japan has held even more. Petrodollar recycling, the process by which oil exporting countries take their dollar revenues and reinvest them in US assets, generated a steady stream of treasury demand from the Middle East. But that arrangement has been fraying. China has been steadily reducing its treasury holdings for years, from that $3 trillion peak to numbers that are now significantly lower and still falling. Russia was cut off from treasury holdings when its assets were frozen after the invasion of Ukraine, an event that made every other foreign government holding US assets think very carefully about the risks involved. Other countries have been quietly diversifying away from treasuries, buying gold, bilateral currency arrangements, and other assets instead. The result is that the buyer base for US treasuries is changing, and not in a direction that's favorable for keeping yields low. The third signal, and in some ways the most alarming, is the sheer quantity of treasury debt that needs to be sold in the coming months and years. The US government is running deficits of roughly $1.5 to $2 trillion per year. That's how much more it's spending than it takes in through taxes. Every dollar of that deficit needs to be financed by selling new bonds. But it's not just the new deficit. There's also a massive amount of existing debt that is constantly maturing, meaning the government has to refinance it by selling new bonds to replace the old ones. The total amount of treasury debt that needs to be rolled over and newly issued in any given year is now measured in the tens of trillions of dollars annually when you account for short-term bills, notes, and bonds. The US Treasury market has to absorb an extraordinary, unprecedented volume of new supply. And when supply exceeds demand, prices fall, which means yields rise, which means the cost of all that borrowing goes up, which makes the deficit even larger, which requires even more borrowing. You can see how this becomes a self-reinforcing loop that, if left unchecked, leads somewhere very uncomfortable very quickly. The fourth signal is what's happening with term premium. Term premium is the extra yield that investors demand to compensate for the uncertainty and risk of holding a long-term bond rather than a short-term bond. When investors feel confident about the future, confident that inflation will stay low, that the government's finances are sound, that the dollar will maintain its value, term premium is low or even negative, meaning investors are willing to accept a lower rate on long-term bonds relative to what they get rolling over short-term bonds. For most of the period from 2010 to 2022, term premium in the US was negative or near zero. Investors had such confidence in the US government and the Fed's ability to control inflation that they essentially demanded no extra compensation for holding 10 or 30-year bonds over short-term alternatives. But that has changed. Term premium has risen sharply. Investors are now demanding meaningful extra compensation to hold long-term US debt, which tells you something very important about how sophisticated investors are reassessing the risks of holding long-duration US Treasury bonds. They're seeing something in the fiscal trajectory and the monetary environment that makes them want more reward for taking the risk of lending to the US government for 10 or 30 years. Now let's connect all of these signals to the code red moment specifically, because I don't want to just describe a general deterioration in the Treasury market. I want to explain what happened that elevated this from a concerning background trend to an acute alarm. There have been periods recently where Treasury yields spiked sharply in very short timeframes, moves of 20, 30, 40 basis points in just a few days or even a single day, without any obvious catalyst that would normally justify such a move. In a liquid, well-functioning market, moves of that magnitude in the world's most important bond market simply don't happen without major fundamental news. When they happen without clear news, it suggests something more disturbing, that the market's capacity to absorb selling pressure is impaired, that there are moments when liquidity, the ability to buy or sell without dramatically moving the price, breaks down in the Treasury market in ways that weren't supposed to be possible. This is the code red. The US Treasury market, which is supposed to be the deepest, most liquid, most stable financial market in the world, has been showing flashes of dysfunction that are genuinely alarming to anyone who understands what a smoothly functioning Treasury market means for the rest of the global financial system. Let me give you a sense of why Treasury market dysfunction is so uniquely dangerous, because I think most people underestimate it. Every major financial institution on the planet, every bank, every insurance company, every pension fund, every hedge fund uses US Treasury bonds as the bedrock of their operations. Treasuries are the collateral that backs trillions of dollars of financial transactions. Treasuries are what banks hold as liquid reserves. Treasuries are the assets against which financial institutions borrow money in the overnight repo market, the plumbing of the financial system that makes sure money gets where it needs to go every single night. When treasuries start behaving in unexpected, volatile, dysfunctional ways, it doesn't just affect bond investors, it threatens the functioning of the entire financial plumbing system. We got a preview of what this looks like in March 2020 when the COVID shock hit and the Treasury market, even the Treasury market, started to seize up. Bid-ask spreads exploded. Liquidity evaporated. The Federal Reserve had to step in with unlimited buying to prevent a complete market breakdown. The lesson from March 2020 is that the Treasury market is not as invulnerable as everyone assumed, and the factors that caused that temporary breakdown in 2020, too much supply, too much volatility, too little liquidity, are now structural features of the market, not temporary anomalies caused by a once-in-a-century pandemic shock. The role of hedge funds in this story is something that deserves careful explanation because it's one of the technical drivers of the instability that most people haven't heard much about. There's a trade that has become extremely popular in the hedge fund world over the past several years called the basis trade. In simple terms, it involves exploiting tiny price differences between Treasury bonds and Treasury futures contracts. The trade works because these two things, the actual bond and the futures contract based on that bond, should theoretically be priced almost identically, but in practice there are small differences that arbitrators can profit from. The catch is that the profit from any single instance of this trade is tiny, a few basis points, so to make meaningful money, hedge funds apply enormous leverage. We're talking about leverage ratios of 50 to 100 to 1, sometimes even more. Hedge funds borrow against their treasury positions in the repo market to amplify the returns from these tiny spreads into something that justifies their existence. The problem is that this creates a situation where a huge amount of borrowed money is sitting in positions that are theoretically safe. They're US treasuries, after all, but are practically very vulnerable to any sudden volatility. If treasury prices move unexpectedly, leveraged hedge funds face margin calls. To meet those margin calls, they have to sell treasuries. But everyone is selling at the same time, which drives treasury prices down further, which creates more margin calls, which forces more selling. This is a classic liquidity spiral, and it's exactly what threatened to happen in 2020 and what the Federal Reserve's intervention prevented. The basis trade has grown even larger since then. The leverage is even more extreme, and the potential for a destabilizing unwind is, if anything, greater than it was in 2020. Now let's bring in the Federal Reserve, because you can't talk about the bond market without talking about the Fed, and the Fed's position right now is genuinely complicated in a way that makes the code red signal even more concerning. The Fed has two mandates: price stability, keeping inflation low, and maximum employment. But in practice, it has developed an implicit third mandate over the past few decades, keeping financial conditions stable enough that markets function and the economy doesn't spiral into crisis. For most of the period since the 2008 financial crisis, these three mandates have been more or less compatible. Low inflation allowed the Fed to keep rates low, which supported markets and employment simultaneously. But the inflation surge of 2021 and 2022 broke that compatibility. The Fed had to raise rates aggressively to fight inflation, and raising rates meant higher yields, lower bond prices, and significant pain for anyone holding long-duration assets. That raised rates regime is now creating a new set of problems. Higher rates mean higher government borrowing costs, which means the deficit gets bigger, which means more treasury issuance, which means more upward pressure on yields. It's a feedback loop that the Fed has limited ability to break without appearing to abandon its inflation-fighting mandate. If the Fed cuts rates aggressively to relieve pressure on the bond market, inflation could re-accelerate. If it keeps rates high, the debt spiral gets worse. This is the bind that the Fed is in, and it's a bind that sophisticated market participants recognize as having no obviously clean exit. There's a concept in finance called fiscal dominance, and it's worth spending some time on because it describes exactly the scenario that some analysts believe the US is now entering. Fiscal dominance occurs when a government's fiscal situation, its debt levels and deficits, becomes so large and so unmanageable that it effectively constrains the central bank's ability to conduct independent monetary policy. In a fiscally dominant regime, the central bank can't raise rates too high or hold them high for too long because the government's interest bill becomes unbearable. It can't let yields rise freely because the bond market would go into crisis. Instead, it's forced, either explicitly or implicitly, to keep rates artificially low and to absorb excess treasury supply through bond purchases. This process is called yield curve control when it's done explicitly, and financial repression when it's done more subtly. And the consequence is that inflation tends to run higher than the central bank would officially target, because the monetary policy needed to fight inflation is prevented by the fiscal situation. Japan has been living in a variant of this regime for decades. Some analysts, serious, credentialed, mainstream analysts, are now arguing that the United States is in the early stages of fiscal dominance. If they're right, the implications for bond yields, inflation, the dollar, and almost every other asset class are profound. Let's talk about what this means for stocks, because a lot of people watching this are primarily stock market investors who are wondering whether the bond market's problems affect their equity portfolio. The answer is absolutely yes, and in several ways. The most direct channel is through valuations. Stock prices are derived, at least in theory, from the present value of future earnings, which means you discount future cash flows at some interest rate to get to today's value. When risk-free rates were near zero, The discount rate was very low, which meant future earnings were worth a lot in today's dollars, which justified high valuations, high price to earnings multiples. When risk-free rates rise, when treasury yields go up, the discount rate rises, which means future earnings are worth less today, which should push valuations down. This is the mechanism by which higher bond yields are fundamentally bearish for stock valuations, all else equal. And the further that yields rise, especially if they rise to levels that reflect a genuine concern about U.S. fiscal sustainability rather than just normal economic growth, the more pressure there is on stock multiples. The second channel is through credit conditions. Higher treasury yields lead to higher corporate bond yields, which means higher borrowing costs for companies. Companies with heavy debt loads or with business models that depend on cheap financing, leverage buyout candidates, commercial real estate, highly indebted industrial companies face genuine earnings headwinds when rates stay high. The third channel is through confidence and risk appetite. When the bond market is sending distress signals, sophisticated investors reduce risk across the board. They sell equities, reduce leverage, move toward cash and shorter duration assets. This risk-off dynamic can feed on itself, creating sell-offs that are driven more by financial system stress than by any change in corporate fundamentals. Here's something that I think is genuinely underappreciated about the current moment, and it has to do with how the tools that have worked in the past to stabilize markets might be less effective going forward. In every major financial crisis since at least the 1990s, the 1998 LTCM crisis, the 2000-2001 tech bust, the 2008-2009 financial crisis, the 2020 COVID crash, the Federal Reserve's response was the same: cut rates, provide liquidity, if necessary buy assets. This playbook worked. Markets stabilized. Economies recovered. The lesson that markets learned from all of these episodes was the Fed has your back. Buy the dip. The cavalry is coming. And that learned behavior, the belief in the Fed put, the expectation that any serious financial trouble would be met with massive monetary easing, has shaped investor behavior profoundly for a generation. But here's the problem with that playbook in 2026. The Fed is fighting inflation that is still above its target. If it cuts rates aggressively in response to a bond market or stock market crisis, it risks reigniting inflation, or it risks signaling that it's willing to trade inflation control for financial stability, which could itself trigger a loss of confidence in the dollar and potentially make the bond market crisis worse rather than better. The Fed put might still exist, but its exercise price, the level of market pain at which the Fed is willing to override its inflation mandate, is much higher than markets have become accustomed to assuming. And that uncertainty about Fed support is itself a destabilizing factor. Let's bring in the international dimension, because the code red signal in the US bond market doesn't exist in isolation. It's happening against a backdrop of significant global financial stress and geopolitical tension that amplifies the risks. The US dollar status as the world's reserve currency has been the ultimate backstop for the treasury market for 80 years. As long as global trade is denominated primarily in dollars, as long as the dollar is what everyone needs to buy oil and commodities and conduct international business, there will always be demand for dollar assets, including treasuries. But that status is under more pressure than it's been since Bretton Woods. BRICS countries, Brazil, Russia, India, China, South Africa, and their newer members have been actively working to create alternative payment arrangements that bypass the dollar. China and Saudi Arabia have conducted oil transactions in yuan. Many bilateral trade agreements are being structured in local currencies rather than dollars. The share of global currency reserves held in dollars, while still the largest single component, has been declining for years. None of this means the dollar is about to collapse or that treasuries are about to lose their reserve status overnight. These are slow, moving structural changes, not cliff events. But they add to the supply-demand imbalance in the treasury market by gradually reducing the pool of automatically captive buyers who need to hold dollar assets regardless of yield or risk. The relationship between gold and the bond market is something worth examining here, because gold has historically been the clearest signal of what sophisticated money is thinking about currency and fiscal risk. Gold hit all-time highs in 2024 and has continued to climb in 2025 and 2026. Central banks around the world, particularly in emerging markets, have been buying gold at the fastest pace in decades. This is not a coincidence. When central banks buy gold, they are making an explicit statement. They want an asset that carries no counterparty risk, that cannot be frozen or sanctioned. That has maintained value across thousands of years and across every monetary regime change in history. The fact that central bank gold buying has accelerated at precisely the same time that U.S. Treasury yields are rising and U.S. fiscal dynamics are deteriorating is not a coincidence. It is a signal from some of the most sophisticated institutional investors on the planet that they are hedging against exactly the scenario that the code red in the bond market represents, a scenario where U.S. Treasuries are no longer the unquestioned risk-free asset they've been for generations. Now let me talk about what happened historically when other countries experienced the kind of bond market stress that the US is now showing early signs of, because history is instructive here, even if the US situation is unique in important ways. In 2010 to 2012, Greece, Portugal, Ireland, Spain, and Italy all experienced what became known as the European debt crisis. The pattern in each case was similar: government debts rose to levels that markets questioned, bond yields spiked, borrowing costs became unsustainable, governments had to implement painful austerity measures, and the social and economic consequences were severe. Greece was the most extreme case. It effectively defaulted on its debt and required multiple bailouts, and its economy shrank by something like 25% over several years. The analogy to the US has important limits. The US borrows in its own currency, which gives it options that Greece didn't have inside the Eurozone. The US can, in extremis, print money to service its debts in a way that Greece couldn't. But that option, printing money, comes with its own cost, which is inflation and potential currency debasement. In 2022, the UK experienced a mini version of this dynamic when the Liz Truss government announced unfunded tax cuts, and the bond market, the gilt market, revolted. Yields spiked so sharply in a matter of days that pension funds faced margin calls that threatened their solvency, and the Bank of England had to step in with emergency bond purchases to prevent a systemic crisis. Liz Truss was gone within weeks. The bond market fired the UK Prime Minister, and the lesson was stark and memorable. Even developed market governments with their own currencies are not immune from bond market discipline. The question is not whether that discipline applies to the US. It's whether the US is approaching the point where it begins to assert itself. Let me be very clear about something here, because I don't want to overstate the case. The United States is not Greece. It is not the UK of 2022. The US dollar's reserve status, the depth of the US financial system, the diversification of the US economy, and the historical credibility of US institutions give the US a degree of financial flexibility that no other country possesses. The bond market can flash warning signals for a long time before they become acute crises. And there are scenarios, fiscal adjustments, productivity boosts from technology, stronger economic growth, that could help stabilize the trajectory without a crisis. I am not here to tell you that a US bond market crisis is inevitable or imminent. What I am telling you is that the signal is real, the people taking it seriously are serious people, and the risks are larger and more concrete than they've been since at least 2008, and arguably since the 1970s. That's worth understanding, worth tracking, and worth incorporating into how you think about your financial situation, even if you ultimately conclude that the crisis scenario is unlikely to materialize in its most severe form. So, what does Wall Street actually do with this code red signal? Because there's a difference between what Wall Street says in public and what it does with its own money, and the gap between those two things is often the most informative signal of all. In public, Wall Street tends to project confidence. Banks have clients and investors who need to feel good about keeping their money in the system. Dramatic warnings about bond market dysfunction are bad for business. They make clients nervous. They raise uncomfortable questions about portfolio construction. They suggest that the fundamental premise of modern portfolio theory, that the risk-free rate is actually risk-free, might need revisiting. So publicly, the messaging tends to be measured. We're monitoring the situation. There are risks but also opportunities. Diversification remains key. But privately, and in the positioning data that sophisticated analysts track, you see something different. You see a gradual but real shift in how professional investors are structuring their portfolios. More inflation hedges, more gold and commodities, shorter duration in fixed income, meaning a preference for bonds that mature soon rather than in 10 or 30 years, reducing exposure to interest rate risk, more attention to the quality and sustainability of corporate balance sheets, more consideration of international diversification. These are the moves that people who take the code red signal seriously are making. Not dramatic, not all at once, but methodical and directional. The MOVI index is something worth mentioning here because it's a tool that traders use to measure volatility in the bond market in the same way that the VIX measures volatility in the stock market. When the MOVI index spikes, it signals that bond market participants are paying elevated prices for options, which means they're worried about large, unexpected moves in yields. MOVI index readings above 100 are considered elevated. Above 150 is alarming. In recent periods, the MOVI index has been registering at levels that signal genuine stress, not the casual noise of a normal market, but the kind of volatility that indicates professionals are hedging against potentially large dislocations. This is another data point that contributes to the code red designation. It's not just one thing, it's a convergence of rising yields, foreign demand concerns, liquidity episodes, basis trade risks, fiscal trajectory worries, and elevated volatility, all pointing in the same direction at the same time. Let's talk about what this means for ordinary people, people who aren't hedge fund managers or bond market specialists, because all of this technical analysis only matters if it connects to real-world consequences that affect how people live and plan. The most direct transmission mechanism to ordinary people is through mortgage rates. The 30-year fixed mortgage rate in the United States is closely linked to the 10-year treasury yield. When the 10-year yield rises, mortgage rates rise. We saw this dramatically in 2022 and 2023, when mortgage rates went from roughly 3% to nearly 8% in about 18 months, one of the fastest rises in mortgage rate history. The housing market effectively froze. People who had locked in 3% mortgages couldn't afford to sell and move into a new home at 7% or 8%. First-time buyers found that the same monthly payment that would have bought a $400,000 house in 2021 would only buy a $250,000 house in 2023. If bond market stress drives long-term yields higher from here, which is one of the scenarios the code red is warning about, mortgage rates could stay elevated or even rise further, keeping the housing market in a state of prolonged stress. For the millions of Americans who count on their home as their primary financial asset, this matters enormously. Credit card rates are another transmission mechanism. Credit card interest rates are linked to the federal funds rate, which the Fed sets. But the broader credit environment, how willing banks are to extend credit and at what terms, is influenced by the bond market more broadly. When the bond market signals stress, banks tighten lending standards. They become more cautious about who they lend to and on what terms. This credit tightening hits small businesses first. They depend on bank lending more than large corporations, which can issue bonds directly. It hits lower income consumers first. They have less cushion and are more dependent on credit for everyday expenses. And it creates a feedback loop where tighter credit leads to slower economic activity, which leads to higher default rates, which leads to even tighter credit. This is the mechanism by which a bond market disruption translates into recession, and it's one of the scenarios that the code red signal is warning could be coming. Pension funds deserve a special mention here because they are one of the institutional actors most directly exposed to what's happening in the bond market, and their situation affects tens of millions of Americans who depend on pension income in retirement. Pension funds have massive holdings of long-duration bonds. When long-term bond yields rise and prices fall, the mark-to-market value of those holdings declines, sometimes dramatically. The UK pension crisis of 2022 that I mentioned earlier was a preview of what can happen. Pension funds that had used leverage to manage their liability matching suddenly found themselves facing margin calls when yields spiked, and they had to sell assets rapidly into a falling market, which made things worse. US pension funds, both public and private, have some of the same structural vulnerabilities. Many are already underfunded, meaning they have promised more in future benefits than they have assets to cover. If bond market volatility and rising yields further impair their asset values, the underfunding gets worse, and the ultimate guarantor of last resort is taxpayers, either through state and local government obligations or through the Pension Benefit Guaranty Corporation at the federal level. Now I want to address a question that a lot of people have when they hear this kind of analysis. If the bond market is sending a code red signal, why aren't stock markets crashing? If this is so serious, why is the S&P 500 still trading anywhere near its highs? It's a fair question, and it deserves an honest answer. The first part of the answer is that markets can ignore or discount warning signals for extended periods, sometimes very extended periods, before the underlying dynamics assert themselves. In 2006 and early 2007, there were clear warning signals in the mortgage market and the structured credit market that a financial crisis was building. Most stock market participants ignored those signals for over a year before everything came apart in 2008. The warning precedes the event, sometimes by months, sometimes by years. The bond market's code red doesn't mean stocks crash next week. It means the underlying conditions are deteriorating in a way that serious investors need to account for over their planning horizon. The second part of the answer is that there are genuine positive forces in the economy and markets that are counterbalancing the bond market stress, at least for now. The AI technology revolution is creating real economic value and driving genuine earnings growth in certain sectors. The US labor market has remained remarkably resilient. Corporate profits in many sectors have been strong. These are real things that support equity valuations, even as bond market signals flash warning. The question is whether these positive forces are strong enough and durable enough to offset the fiscal and monetary headwinds, and on that question, the jury is genuinely out. There's also the issue of what economists call financial repression, and I think it's one of the most important concepts for understanding what might happen going forward and what it means for how you should think about protecting your own financial situation. Financial repression is the process by which governments and central banks engineer an environment where interest rates are held below the rate of inflation, effectively allowing debts to be eroded in real terms over time. It's a form of quiet default, not an explicit non-payment, but a gradual diminution of the real value of what creditors are owed. The United States used financial repression very effectively in the post-World War II period to reduce the massive debt it had accumulated during the war. From roughly 1945 to 1980, interest rates were often kept below inflation, and the real value of U.S. debt shrank significantly without any explicit default. Holders of treasuries got their principal back in nominal terms, but lost purchasing power in real terms. The tools used to achieve this included regulations that limited where savings institutions could invest, capital controls that kept money from leaving the country, and a variety of other mechanisms that may seem antiquated today. But some analysts believe that new forms of financial repression are both possible and likely in the current environment, including the Fed being pressured to keep rates lower than inflation warrants, expanded regulation of where financial institutions must hold their capital, and other mechanisms that steer money into treasuries regardless of the yield on offer. If financial repression is the road we're going down, what are the investment implications? History suggests that the assets that perform best in financial repression environments are real assets, things with intrinsic value that can't be inflated away. Physical real estate, particularly income, producing property with inflation-linked rental income. Commodities, including gold and silver, which I've covered in depth in other videos. Infrastructure, toll roads, pipelines, utilities, assets that provide essential services and can pass inflation through to customers. Equities in companies with pricing power, businesses that can raise their prices in line with or ahead of inflation because they provide something that people must have and that has no easy substitute. And inflation-protected bonds like T-piece, treasury inflation-protected securities, though these too carry risks if the government's official inflation measurement diverges from actual experienced inflation over time. The common thread is assets with real underlying value and the ability to maintain or grow that value in an environment where the purchasing power of money is being eroded. Let me bring this back to the immediate present and talk about what specific things you should be watching in the coming weeks and months that will tell you whether the code red signal is escalating or stabilizing. The most important data point to watch is Treasury auction results. Every week, the US government auctions new Treasury bonds to raise money. The results of these auctions, specifically the bid-to-cover ratio, which measures how much demand there was relative to the amount offered, and the tail, which measures how much the auction clearing yield exceeded the pre-auction market yield, tell you directly how healthy or stressed the demand picture is. A weak auction, low bid to cover, large tail, signals that buyers are requiring a price concession to absorb the supply, which is a warning signal. A series of weak auctions is a significant escalation of the code red. The second thing to watch is foreign treasury holdings data, which the Treasury Department publishes monthly. If you see continued large declines in holdings by China, Japan, or other major foreign investors, that's a warning that the buyer-based deterioration is continuing. The third thing to watch is the MOVI index. Persistently elevated readings above 130 or 140 suggest ongoing stress rather than normalization. And the fourth thing to watch is the behavior of the 30-year Treasury yield in particular. If it starts approaching levels not seen in decades, it signals that the market is pricing in long-term fiscal and monetary risk in a very serious way. Here's a point about the political dimension of all of this that I think is important to make, because it's easy to look at the bond market in isolation and forget that it exists within a political economy. The decisions that drive fiscal deficits, spending choices, tax policies, entitlement programs are political decisions. The decision about how aggressively to fight inflation versus how much to support financial stability, that's a political decision that the Federal Reserve makes under pressure from the political system. And the willingness to make the difficult choices, spending cuts, tax increases, structural reforms, that would put the fiscal trajectory on a more sustainable path, are ultimately political questions that depend on the will and capacity of the democratic system to make hard choices. Every country that has successfully navigated a sovereign debt crisis, Ireland, Iceland, Canada in the 1990s, did so through a combination of political will, institutional credibility, and sometimes external pressure from markets. Whether the US political system is capable of generating that kind of response is a question that goes well beyond financial analysis, but it's not irrelevant to the financial analysis. The bond market's code red is in part a question about whether the political system will act before the market forces it to act in a much more painful way. The time value of financial preparation is something I want to address directly because there's always a temptation when hearing analysis like this, to either act immediately in a panic-driven way or to decide that since the timeline is uncertain, there's no urgency in doing anything. Both of those responses are wrong. The right response is thoughtful, measured preparation that doesn't require you to predict the exact timing of anything, but does reduce your vulnerability to the scenarios the code red is warning about. This means looking at your fixed income holdings and asking whether you're taking more duration risk, more long-term bond exposure than makes sense given current yields and current risks. It means looking at your overall asset allocation and asking whether it's appropriately diversified across assets that perform differently in different macroeconomic scenarios. It means reducing debt where practical, because high personal debt loads are most painful in environments of high and rising interest rates. It means building cash or short-term liquid reserves that give you options and prevent you from being forced to sell other assets at the wrong time. And it means educating yourself, which you're doing right now, so that when events develop and decisions need to be made, you have a framework for thinking about them rather than reacting emotionally. I want to circle back to something that I mentioned at the beginning and that I think is worth sitting with at the end, because it speaks to a deeper truth about what the code red in the bond market really represents. The US Treasury market is not just a financial market. It is the embodiment of an implicit promise, the promise that the United States will honor its obligations, that the dollar will maintain reasonable value, that the rules of the financial system are stable and credible. For 80 years, since the end of World War II, that promise has been largely kept, and the world has organized its financial affairs around the reliability of that promise. The code red signal is not just about yield levels or auction results or hedge fund leverage. It's about whether confidence in that 80-year-old promise is beginning to erode in ways that could eventually become self-fulfilling. Financial systems, like all systems based on trust, can persist through a lot of stress without breaking, and then break quite suddenly when the trust finally gives way. I'm not predicting that the trust breaks. I'm saying that watching the early signals of stress in that trust, which is what the bond market is providing right now, is one of the most important things that any financially aware person can do in 2026. So where does this leave us? The US bond market has sent a code red signal that reflects several converging pressures: rising long-term yields driven by fiscal deterioration, declining foreign demand for treasuries, enormous and growing supply requirements, structural liquidity vulnerabilities associated with leveraged trading strategies, and an uncertain Fed that faces genuinely conflicting mandates. These are not isolated or temporary factors. They reflect deep structural dynamics that have been building for years and are now becoming impossible to ignore. Wall Street's most sophisticated participants are taking this signal seriously in their positioning, even if the public messaging remains measured and calm. The implications touch everything, from mortgage rates to stock valuations, from pension fund solvency to the global dollar system, from the cost of running the US government to the future of the dollar as the world's reserve currency. None of this means that a crisis is imminent or inevitable. But it does mean that the margin for error is smaller than it's been in a long time, that the stakes are higher, and that the actions of policymakers, central bankers, and political leaders in the coming months and years will determine whether the code red stays a warning or becomes something worse. The bond market has spoken. Now the question is whether anyone with the power to respond will listen, and whether you, with the knowledge you now have, will prepare yourself for whatever comes next.